Hello and welcome to the Mainstream Mortgages podcast. I'm Derek Van Dell, joined as always with Peter Paley and Colton Boudreau. Today we are talking about rental properties. So, as always, we're going to jump right into my first question. Peter, what is considered a rental property or an investment property in Canada?
So rental properties have really picked up in popularity probably over the last 10 years. And I really can't think of too many of our clients who don't have their primary residence and an income generating property. So a rental property can be a house, a condo, or a recreational property like a cottage or a cabin that's going to generate income for you and your family through either a tenant or through a short-term rental like Airbnb or Verbo. So that's basically what we mean when we're talking about rental or investment property.
Awesome. And Colton, let's talk about how qualifying for a rental property differs from qualifying for, say, just an owner-occupied property. So first, what is the difference in down payment requirements on a rental property?
Yeah, so a standalone rental property or investment property, you would need 20% down if it's generating income, just having tenants move in. If you were buying, say, like a duplex and you were living in half and the tenant was living in the other side, then you could get away with 5% down because technically it would be considered your primary residence.
Can I just jump in there too? Because
Yes.
on top of a duplex, you might want to buy a triplex or a fourplex. That would, and if you're going to live in it, it's going to require 10% down. And a little trick that people don't know when they're planning on starting maybe a rental portfolio is the house that you're living in right now. You can convert it into a rental property and then buy a new house that you're going to live in with you and your family for 5% down. So it's a really great way that most people don't understand that you can start your monopoly empire of rental properties by converting the house you're in right now to a rental.
Right. And Peter, you're also kind of the commercial expert amongst us. Isn't there some sort of different minimum down payment required on some commercial rental properties?
Sure.
Speaking of like apartment buildings.
Yeah, so for apartment buildings, like there are some really great programs out there. Like CMHC has their MLI Select program, which would allow a purchaser to buy a whole apartment building with as little as 5% down. And it's really important to highlight that as little as 5% down because the building has to go through a qualification scorecard. The buyer also has to go through a qualification scorecard. And to set one of these up takes many, many months. And you usually need to have 20, 25, or 30% down just to bridge that pre-approval period or that approval period to get to that MLI Select. But it's a really great way for people who maybe have really good experience already being landlords to sort of up their game. So that is something you can do. Or you can take a more traditional approach for an apartment building and put down probably about 30 or 35%, I'd say would be the general rule of thumb for most lenders.
Makes sense. So that's okay. So that's how down payment differs. Colton, how does a lender look at the income side of things, like specifically rental income when qualifying for a mortgage?
Yeah, so it really depends on the lender and the situation, but in the mortgage world, our terms are called an offset or an add back. Um, Add back to income is typically 50%, I would say, is the general rule, whereas the offset can range from 50% to all the way up to 95%. So, how Peter mentioned, converting your existing home into a rental and then buying another property, we're allowed to use 95% offset on that rental income on the property that you're making a rental.
And it's more favorable if you do the offset calculation versus the add back calculation. And without getting into too much detail, add backs suck and offsets are really good. And we'll work with you as you apply for your mortgage and explain the difference then, because it would probably be its whole episode on add backs and offsets.
Yeah, it can get pretty complicated sometimes, but we try to keep it simple for our clients. Peter, how do typical interest rates differ between a rental property and an owner occupied?
So if you're buying a straight rental property with 20% down, most lenders now are in the habit of charging a premium for rental properties, and they'll typically go over a personal residential mortgage lending rate, and they'll increase it by usually about zero point 0.3 to 0.65% higher. And that's to help them offset their own risk or their perceived risk because rental properties, the owner isn't living there, not 100% sure if they're maintaining the property. Maybe you have a bad tenant. Maybe the bad tenant isn't paying rent. Maybe they're ruining the house with like their pets or violence or whatever, right? So there's usually a rental property mortgage premium that's charged by most lenders. That being said, if you do my little trick about converting your existing house to the rental and then buying a new house, well, you still get to keep your existing mortgage rate. And when you renew that mortgage rate, especially if your house had already been insured by one of the insurers, you get to keep that insurance in place. And it guarantees that you'll always have the best rate on that mortgage of the existing house in the future as long as you don't refinance it.
Okay, so just to be clear, you're basically saying that I could go and buy a house and move into it, and then maybe, I don't know, a year or two later, I could buy a different house, move into that one to get, the good rates, and keep my existing house and turn it into a rental property.
Mhm.
So how many times could I just keep buying houses and moving into them and accumulating rentals that way?
Well, I mean, the simple answer is like yes, technically you could do that, but at some point someone's going to drop the boot on you and stop you. Most lenders do have rental property limits, and insurers will limit you to one property per insurer, so that would probably give you three times. And even then, after the second time, they're probably going to get wise to you and decline you and make you go to a more conventional route.
Okay, that seems to make more sense.
Yeah.
Also, you mentioned about the interest rate. It's usually going to be a little bit higher for a rental property. I just wanted to clarify that if you're buying a duplex and you're moving into one unit, you do qualify for the better rate rather than the rental
100%.
rate.
Sorry, I
Yeah,
should have clarified that. Yeah.
that's okay. And since we were talking about commercial rental properties, do you know kind of what that looks like as far as rates go on commercial
Yeah,
rentals?
they're based on market rent, so traditional mortgage rates are out the window when you're moving into this type of lending process, and it's based usually on the cost of funds. And it'll be plus or minus depending how strong the application is. But as a general rule of thumb, if your 5-year fixed mortgage rate on a personal mortgage is 5%, you're going to be anywhere between 1 and 1.5% higher than that for a commercial mortgage rate, as a rule of thumb.
Awesome. Okay, that's good info. Um, Colton, we were talking about down payment a little bit. Let's go back to the down payment topic and say or ask, can we use the equity from our current home to buy a rental property? Is that
Yeah,
possible?
yeah, for sure you can. And I would say it's actually very common. So one, people, if they have a HELOC on their primary residence already, they can use that, which we kind of discussed in our HELOC episode. People can just entirely refinance their home and pull out the equity if they don't want a HELOC. So just pulling out the available funds to go towards the down payment. Or they could go into a product like the Manulife One or the Fusion. We spoke about that in our previous episode on HELOCs as well. That's also a very common and well used product, or products, I should say.
Okay. And is there any like downside to using your home's equity towards a down payment?
Um, so if you're using the HELOC, for instance, then that HELOC, however much you're using for down payment, it has to be accounted for in the application. So when doing that, you could qualify for a little bit less. Um, and then if you're just simply refinancing your property, then your mortgage is obviously going to be higher. The carrying costs are a little bit higher, which also has to be accounted for in the application. So I would say those are the two, if you want to call them downfalls, that have to be
Right.
accounted for. But the real things you have to be um, that we notice, obviously, and talk about to you about.
Okay. So basically what you're saying is if I'm borrowing money for a down payment, I might qualify for a lesser mortgage on the purchase. Right.
Right, because essentially it's
Yeah.
just not free money, right? So
Right.
it's got to be accounted for somewhere, some way, somehow. And depending the route you go, it could impact or your application a little bit more than the other way.
Makes sense. Okay. And okay, so Peter, should our clients buy a rental property through a corporation or should they do it personally?
I was dreading this question. I saw it on the list. And if you ask your accountant, they're going to for sure tell you to do it through a corporation. Then you're going to set up the corporation and come to me, and I'm going to be like, well, it's a lot harder to qualify through your corporation. Most lenders don't like doing it. They prefer to have your personal guarantee and your covenant on the mortgage application. So if you do go that way, one, you're still going to have to give your personal guarantee. Two, your rate's probably going to be higher. And three, like the application process is not as comfortable as if you were doing it in your personal name. So it really comes down to a choice. So you all know that I had a good portfolio of rental properties in my life, and now I only have a couple. And I've done them all in my personal name, and I'm okay with that. Setting up a corporation, maintaining the financial statements, doing the extra tax returns, um, keeping the money separate, not really having access to the money because it's like in your if you take money out of your corporation, you pay more tax. Like for me and Alex, like it was just way easier to keep it personal. And it was also a really good way for us to control what we did expense wise on our tax return on our rental properties to help us control our income and the amount of taxes we paid. And I mean, again, this is totally another episode. And for me personally, I will do it either way. Just keep in mind if you do set up a corporation to do this, you're probably gonna want to have up to 10 rental properties in that corporation to sort of make it worth your while. And then you're going to be paying higher interest rates and more costs and corporate costs and probably not having a lot of access to the money that you're earning. So it'd be a real long-term play. But I mean, if you're buying one rental property to have maybe to help pad your retirement or two, like probably just easier to keep it in your personal name, to be honest. But just my opinion. We can, if you want to debate me on it, call us. Well, we can debate.
Yeah.
I just
I
think it's a
think
lot easier to keep it in your personal name.
Yeah, I think maybe a lawyer or an accountant or both might say even one rental property in a personal name kind of exposes you to liability. So there's that avenue
Yeah,
to look out for. But
there's so much
yeah,
to take into account, and the pluses and minuses are so vast that it's going to be a personal decision for you and what your ultimate goal is by having this rental property or rental property portfolio.
definitely. And as you were alluding to, it's a decision that you should definitely consult multiple professionals about and come to the conclusion on your own rather than just listening to one of us.
Yeah. Like for me, doing it personally worked out really well, but
Mhm,
that doesn't mean it's right for everybody doing it that way.
exactly. Colton, what are some of the biggest mistakes that a first-time real estate investor might make?
I would say the biggest mistake is somebody not realizing that it's a long-term play. It's not about one, you want to cover your expenses, obviously, monthly, but it's not mainly about how much money can I possibly make month to month on a rental. It's the long term, right? So if you're buying a rental, your focus should be on I'm keeping this for quite some time because whenever I sell it or pass it down to my kids or whatever the case might be, um, that's what your goal is, and that's how you build wealth is through that equity. So being short sighted on rentals, I think, is a very big thing. Being focused on the rate so much as well kind of goes hand in hand there. Like, am I? It's just a long-term strategy, and I think you really need to think about it long term and not just jump into the rental game and say, I just need to get a rental to have a rental. You right? So I would say that's the biggest in my mind.
I want to add there because when I started renting out my very first home that I bought, I didn't realize what a pain in the butt it was. I mean, you have maintenance, you have to collect the rent. You won't always have golden tenants, let me tell you that. Um, they are going to miss payments from time to time. Like you need to have some money. Like you can't just keep it so tight and expect everything to go well. You're going to have to maintain the property, your roof, furnace, windows, insulation. Uh, what are some of my other big expenses? I had a grading issue on my property when another home nearby was built. All the water was coming into my house or my rental property. So I had to have the property regraded. Like there's just a lot of extra expenses that you really need to factor in. And I mean, insurance costs now have gone up a lot on rental properties. Like it's way more expensive now than it ever used to be. So I think really planning it out, not just saying, oh, I'm going to get a rental property and then you're underwater and now you're paying for five, $600 a month out of your pocket to make the rental property work. Like I feel like that is um maybe not the best. I mean, if that works for you and you're willing to make that investment for the long-term play, like Colton alluded to, like that's great. But I think the days of you buying a rental property, making $500 a month off each door, like that probably ended 5 or 6 years ago. So now you're gonna buy the property, depending how much money you're putting down or how much equity you have in, there's a good chance you're gonna be a little bit underwater on the monthly expense. Like I mean, yeah, we can use the rent to help cover your mortgage and qualify you and do all the stuff. Like we have a lot of tricks in the toolbox, but you're the one who's paying for it at the end of the day. And if it's too tight and you're losing money, and then you're gonna have to spend 10, 15, $20,000 in maintenance costs, like if there's like some big maintenance costs coming upon the property, then you really want to do that planning part. And I feel that maybe over the last, I don't know, 8 or 9 years, there's been a lot of seminars, use other people's money, invest here, do this, do that. But I mean, at the end of the day, like 1 or 2% of the people who do that are going to be successful, and the other 90 to 95% of the people are going to lose their shirt. So, I mean, it's really important that you are informed about this. And I think using a professional like us is going to be really great. Like we have a huge rental portfolio of people that we've helped in multiple different situations from converting their existing home, buying rental, or increasing their portfolio. Like we've done it all. So call us, right?
Absolutely. Yeah, absolutely. Call us Mainstream Mortgages. You can reach us at 431-482-2187, or you can email us at greatrates@mainstreammortgages.com. Thank you so much, everybody, for listening today, and have a great day.
Thank you.